Hi, everyone. I'd like to finish up talking about Chapter 13. And actually, I'm going to come back to individual retirement accounts. And I'd like to spend a few minutes on that before we wrap up those little problems, but little areas we still didn't talk about. So I'd like to bring your attention to page 1319. And that's what I was looking for the other day when we started talking about IRAs. And we're going to go through some of the examples over the next few pages there, so you really understand and get a good understanding of individual retirement accounts. Now, when it comes to individual retirement accounts, remember we have the traditional and the Roth. So first we're going to focus on the traditional. Now, remember the other day we said, if you are not a participant in an employer-sponsored plan, okay, you can deduct for each taxpayer on the tax return, which would only be one or two, the lesser of the contribution, $6,000 or earned income. Okay, so you can contribute and deduct basically up to $6,000 or earned income. Of course, if your contribution is less than $6,000, you would compare that to earned income. Now, if you're 50 or older, that goes up to $7,000. So if you are a single head of household taxpayer, you don't have an employer-sponsored retirement plan, your contributions up to earned income, so your earned income has to be at least what your contribution is or higher, can be contributed and deducted. And that's up for 50-year-olds, it's up to $7,000. So that's our general rule. But what happens if you are a participant in an employer-sponsored plan? So now there are limitations. So if you are unmarried, take a look on the bottom of page 1319. We're going to go into 1320. And I may even pull up a Word document here or just walk through some examples. If you are unmarried, this is right under example 1315. And actually, I should probably go back to my previous slide. If you are unmarried and you participate in an employer-sponsored plan, you can still contribute to a traditional IRA up to $6,000 or earned income, but the deduction may be limited or not allowed at all for that contribution. So the 3 bullet points there discuss when you can take a deduction, when it may phase out or may not be allowed at all. So let's take a look at the first one. It says you're Maggie. Okay, so the taxpayer is Maggie. Go back. So modified adjusted gross income. So basically, that is the taxpayer's AGI without any other IRA deductions subtracted yet. And there are some other little items that they don't talk about, are kind of beyond our scope. But generally, you're looking at AGI before any kind of IRA deduction. That's what the Maggie is for this purpose. If it's less than $65,000, you can deduct your contribution up to the normal limitations. However, if your Maggie is between 65 and 75, you will not get that full contribution deduction. It phases out, and it'll phase out over that range. If your Maggie is above 75,000, you can contribute to a traditional IRA, but you cannot deduct any of it on your tax return. Let's go to, I just want to see. Okay, there we go. There it is. Oh, that's the Roth IRA. Okay, if you go to page 1321, okay, we have Tina. Tina earned $60,000. Because she contributes $2,400 of her salary to a 401k plan, her taxable income from her job is $57,600. If you remember what we were talking about the other day, when you contribute to a 401k, that is the contribution is subtracted from your gross pay and not taxed. Tina would like to make the maximum deductible contribution. So she can make a contribution up to $6,000 because her earned income is above $6,000. But she wants to make a maximum contribution and have it fully deductible. So because Tina is a participant in a retirement plan, the $6,000 limit is subject to phase out if her Maggie is above $65,000. In this case, it isn't. Okay, her Maggie is $57,600. So she can contribute $6,000 and deduct the full $6,000. What if instead her earnings are $68,000? Because of her 401k plan, her Maggie is at $65,600. She wants to make the maximum contribution allowed. Because, now go to the answer, because Tina is a participant in a retirement plan, the $6,000 deduction is subject to phase out. Okay. So how much? Take her Maggie as it currently stands, $65,600 minus the lower end of the phase out range, $65,000. It phases out over a $10,000 range. So 600 divided by 10,000, 6%. So the $6,000 contribution limit is reduced by 6%. So the maximum deductible contribution, she can contribute $6,000, but she can only deduct $5,640, 94% of it. Now, let's say okay, we'll talk about married in a second. Okay, now if her Maggie was above $75,000, none of it's deductible. She can make the contribution, none of it's deductible. The same thing applies to married individuals, but married individuals, now you're looking at two separate individuals on the same tax return. They would both have their own individual retirement accounts, traditional, and they can both contribute up to $6,000 or earned income. Now, a non-working spouse can have a contribution made by their working spouse as long as the amount together is more than the working spouse's earned income. Further, if the working spouse or both spouses who work are in employer-sponsored plans, we also have to limit the amount they can deduct from contributions made. So here it goes. Their phase out starts now, and you got to be careful here because there's different phase outs for different situations. If one of the spouses is an active participant in the employer's retirement plan, okay, and the assumption is the other spouse isn't. So if your Maggie together is less than 104,000, excuse me, okay, fully deductible contributions. If your Maggie together is between 104 and 124, it phases out. If your Maggie is greater than 124, you have no deduction at all. Now, what happens if top of the next page, if one spouse is an active participant and the other one is not. So bottom of the page is you have a working spouse and a non-working spouse. Top of the page, both are working. One is actively a participant, the other is not. Watch how this happens. Wait one second, I think I messed it up. Okay, I'm sorry. Bottom of the page applies if both spouses are working too. Okay, so the bottom of the page is one spouse is an active participant. This is the phase out that the working spouse will use to determine how much of their contribution is deductible. Top of the next page, the other spouse who is not an active participant will use this phase out to determine how much of their contribution is deductible. So it's much higher, as you can see. Married taxpayers who file separately have their own system. So now let's take a look down at the bottom. Assume Tina is married, files a joint return with spouse Steve. Tina is a participant in the 401k plan, receives $60,000 in salary. Steve is a full-time student and is unemployed. Assuming the couple's Maggie is $60,000, what is the maximum deductible IRA contribution that could be made for the year? What is Steve's? Excuse me. So because the Maggie of the spouse who's the active participant is less than $104,000, all of Tina's contribution is deductible. Further, Steve, even though he doesn't work, Tina could make a spousal IRA contribution, okay, of $6,000. So jointly $12,000. And which is the couple's earned income minus Tina's. Okay. And it would be fully deductible. Now, assume the same facts, except Tina and Steve file separately. They are very stringent on people who file separately. Okay, so you can make a contribution, but if either spouse, this is back on page 1321, if either spouse is an active participant in an employer's retirement plan, then each spouse's deductible contribution is phased out over that spouse's Maggie as follows. Okay, so the one who is the active participant, if their Maggie is 0, okay, then they could take the full deduction, which doesn't matter because they don't have any income. They could phase out the deductible contribution between 0 and 10,000 of Maggie. And then once they have Maggie of 10,000 or more, it's fully phased out. So guess what? Married filing separately usually don't get a deductible traditional IRA contribution. Okay, so that's what we wanted to bring to your attention there. That's what I was looking for the other day. We talked about when you can make a contribution. So you could determine the amount you want to make of the contribution after the tax year's ended when you're working on that prior year's tax return, and then make that contribution by April 15th of that next year. And that's just always been the rule. Now, how are distributions taxed? Well, assuming you get a fully deductible contribution, there is a part of the chapter on page 1322 that talks about what if you don't get to fully deduct all your contributions? Well, here's what I'll say about that. And that's down right in the non-deductible. What you do is you take the amount of the contributions you were never able to deduct and divide that by the account balance. And that percentage of your distribution is not taxed because you were never able to deduct it when you made the contribution. Otherwise, Distributions from a traditional IRA are all taxed as ordinary income if you take them out before 59 and a half, except for some extenuating circumstances listed. You will also have a 10% penalty. So if you take the money out and spend it, 10% penalty. Now there's another exception. You can, what we do call rollover. You can take it from one retirement and roll it over automatically into another retirement. Then you're generally not taxed on the money or get the 10% penalty. This also has required minimum distributions. We already talked about those. Roth IRAs, before we take a look at traditional 401k plans, or I think we're gonna kind of roll through those. We already looked at them. On page 1323, Roth IRAs run a little different, and I'm actually gonna stop sharing that and grab a Word document and share that with you. Okay, give me a second to get it here. Okay, so a Roth IRA, none of the contributions are deductible. And contributions may be limited because of Maggie. Okay, so with Roth IRAs, remember, you open them up. If you leave them intact, that plan intact for 5 years, when you take money out at retirement, 59 and a half, none of it is taxable, not even the earnings. You take it out before 59 and a half, the earnings are taxed and penalized. Okay, now the limitation for the contribution is, again, could be up to $6,000 per person or $7,000, again, if over 50 years old. However, take a look, page 1323. Your contribution to a Roth IRA is determined each year. Now you can make it in the following year, but it's based on your Maggie, which would be your modified adjusted, your AGI, okay, without taking into an account any IRA. Unmarried, if your Maggie is less than 124,000, you can make a full contribution to a Roth IRA. If your Maggie is between 124 and 139, your $6,000 contribution amount will phase out. And once your Maggie's at 139,000, you are not allowed a contribution in that year. So you do this test every year. For married individuals, their phase out starts at 196,000. And once they reach 206,000, done, no contribution. And then you could see the limits for those married filing separately. They basically can't have a Roth IRA. So let's say we have, I don't know if we have any examples here with Tina. Okay. Now, let's say we have taxpayer, single, Maggie, $90,000. Okay, so it doesn't matter if they are involved in an employer-sponsored retirement plan, nothing. It's solely based on Maggie, age, and earned income, of course, because earned income, again, if they don't make at least 6,000, they can't even contribute 6,000. So here, their Maggie is less than 124,000. Whoops. So they get a full $6,000 contribution. Remember, none of that is deductible. What if their Maggie, though, for this single individual, ends up being 130,000? Well, now we say, okay, 130,000 minus the lower end of the phase out. So there's $6,000 above the phase out, and the phase out is over $15,000 range, 124 to 139. So 6,000 divided by 15, they are not allowed. Okay, not allowed a 40%. So 40% is not allowed. So of the 6,000 that they usually can take, they are allowed to make a $3,600 contribution. 60% of 6,000 for that year. And you would deal with it the same way for married filing joint individuals. Okay, so wanted to bring that to your attention. Bottom of the page on 1323. Again, have the same requirements for distributions as a traditional IRA or a 401k, any retirement plan when it comes to early distribution. But if you take a normal distribution, that means it's at retirement or you meet an exception, none of it is taxed as long as you left it in the retirement for 5 years from the date of opening it. Okay. One or two more things. IRA contributions are not per IRA, it's total overall. So if you have a traditional IRA and a Roth IRA, you can make a total of a $6,000 contribution in aggregate, not $6,000 to each. Take a look on the bottom of page 1324. We're going to take a look at some distribution examples. Assume Tina started working. She made a one-time contribution of $4,000 to a Roth IRA. Years later, she retired at 65. Her Roth IRA value was $60,000. What happens if she receives $10,000 as a distribution? Well, it's normal. There's no taxes and no penalties. She left it in there for 5 years. She's good to go. Assume the same facts for Tina. She receives a $10,000 distribution when she's 57, and she's not meeting any of the exceptions. Well, now we have to take a look. What amount did she receive above her original investment in the plan? Because it's only the earnings that are taxed if you take it out early. The earnings are subject to the penalty. So she had $4,000 as her original investment. When she took $10,000 out, even though she might, let's see. Okay. She will pay $10,000 minus $6,000 times her marginal tax rate, then an additional 10% penalty because she took it out early. What happens if she's 62 when she takes it out? When she opened it, 3 years later, she withdrew the entire account balance of $5,000. Well, she didn't leave it in there for 5 years. So now she has to pay tax on the earnings, the $1,000 difference. She has no penalty because she's over 59 and a half. So that's how that works. Now, sometimes people will change. They'll transfer money from their traditional IRA or convert it into a Roth IRA. Now, what's the big deal there? Well, a traditional IRA, if you are able to deduct your contributions, is money that's not been taxed yet. Okay, that money has not been taxed yet. Roth IRA is funded with money that is not deductible, so it's been taxed. So when we transfer from a non-taxed IRA to a taxed IRA, we got some funny stuff happening, even though it's a rollover. Take a look on page 1325. Let's assume that in the year she graduated from, Tina, I guess, I don't know. Graduated from college and began working for CBA. Yeah. Tina made a fully deductible $4,000 contribution to a regular traditional IRA, and she deducted all $4,000. 3 years later, she decides to transfer the entire $5,000 balance into a Roth IRA. Well, none of that $5,000 was taxed yet. So the date she transfers that, she must pay income tax on that full rollover, even though it's going into another retirement system, retirement entity, I guess you can say. So she'll pay $1,100 in tax. What amount of tax and penalty would Tina be required to pay if she converted the traditional into a Roth through a rollover by taking a $5,000 distribution from the traditional IRA and then contributing the funds to a Roth IRA? Well, here's the thing. Normally, when you do what's called a rollover from one retirement to another, usually you're going from non-taxed income or money contributions into another non-taxed. It's just that a Roth IRA is taxed money already. That's why she had to pay. So let's say she went from a 401k, she left her employer, and she decided to take that money with her and put it right into a traditional IRA. That is a rollover from one retirement system where the money was not taxed, that contribution, and the same with the traditional IRA. There's no tax implication as long as she never saw the money. There was never a check written out to her. In other words, she told her employer, here's my IRA account, have that rolled right into that, have it put right in there, deposit it. The question becomes, what if Tina receives the cash, like in this next example, and then goes to the bank and opens up her IRA, her traditional IRA? Does she have an issue? As long as she does it within 60 days and she puts the full amount in, no. It's like it's a regular rollover. And that's what we're talking about here. She would only owe $1,100 from moving the money from a traditional IRA to a Roth IRA. She doesn't owe the money because she rolled over. She owes, or the dynamics of the transaction, I should say. She doesn't pay tax because she got the money as a check and then opened up the account. She's paying it because she's going from non-taxed money to a retirement plan that the assumption was the money was already taxed. That's what a Roth IRA is. So since she hasn't paid tax on that traditional IRA money yet, she has to pay it before she, in the same year, I should say, that she puts the money into the Roth IRA. How would that change if she took the $5,000 distribution, kept $1,100 out to pay the tax liability, and only put $3,900 to the Roth IRA, assuming she's not at retirement yet. She's not 59 and a half. Well, this is what I'm saying. She got the money. She said, oh, I'm going to owe $1,100 in taxes. So I'm not going to put that into the Roth IRA. I'm going to save that money for the taxes and I'll just put the difference into the Roth IRA. Well, when you take a distribution before retirement, before 59 and a half, if you don't roll that entire amount, even though you owe taxes on it, the entire amount, or I should say, you will pay taxes on the difference between what you received from that original retirement and what you rolled over. So since she only rolled over 3,900 of it, she would not only pay tax, but she will also have a penalty, a 10% penalty on that difference. Okay, so yeah. So what do we like to do? Roll over direct. We don't like to see our clients have money. So we hit all those different items there. All right, so that's it with IRAs. And actually, that discussion about rollovers, that applies to any kind of retirement account. So you want to make sure, number one, you want to see, what am I rolling over? Am I rolling over money that's been already taxed? And where am I rolling it into? So if you are rolling over something from a 401k or a traditional IRA where you were able to deduct all your contributions, that money has not been taxed yet. if you roll it into some retirement that traditionally the money is not taxed, so you roll it into a traditional IRA where you can deduct your contributions, you won't pay any income tax on that rollover. It's when you're rolling it over into a Roth IRA, and that's the key. It's the Roth IRA that will trigger income tax on the money that's being rolled over because it's never been taxed yet. Whew. Okay, going back to the PowerPoint to wrap up these other funky type of retirements. Not funky, but they're special. Not because they're nice or cute, but they go for special things. We talked about 401ks. Now there are Roth 401k plans that could be made through your employer. Remember, the traditional IRA, your money isn't taxed before it's contributed. In a Roth 401k, your money would be taxed, okay? And then it would be contributed. Then when you get the money out at retirement, none of it's taxable. And that's what we're talking about here. On a Roth 401k, there's no required distribution for 2020, and that's just for everybody. And when it comes to a Roth 401k, it operates like a Roth IRA. When you take distributions out, early, a non-qualified distribution, they're calling that. So you take it out before the 5 years are up, or you're not 59 and a half unless you meet an exception, then you're paying tax only on the earnings when you receive them. Now, deferred compensation plans. Okay, are available and can be used by employers to compensate employees and to help them save for retirement. And I passed the page. We're on page 1315, and I'm not going to spend a lot of time on them, but they are available when, the 401k, you can only contribute so much, and so could your employer. So we can use these to be able to save even more. Now, what is it? Take a look. Employers may offer non-qualified deferred compensation plans. This permits employees to defer current salary in exchange for a future payment from the employer. Now, from an employee's perspective, contributions and distributions from these are similar to a retirement plan. So it's a way to save additional money because you save too much through your retirement. And that's basically what I have to say about that. Now, what about self-employed individuals? We're going to go ahead over to the very end of the chapter, because remember, so far we've talked about people who work, okay, or just individuals who aren't self-employed. Self-employed people have some nice options when it comes to saving for retirement and being able to deduct it on their tax return. So we have the SEP, which stands for Simplified Employee Pension, and the individual 401k. Excuse me. So page 1327. Okay. So they just talk about what these are there. We want to focus on, go to 1328. So this is a SEP, Simplified Employee Pension. Okay. It can be administered or created through an individual retirement account. So they call them SEPs, IRAs. simplified employee pension through an IRA. Who can do this? The owner of a sole proprietorship. They can make annual contributions up to, for themselves, the lesser of $57,000 or 20% of their profit from their Schedule C minus that 1/2 deduction we take as a deduction for adjusted gross income for self-employment tax. If you have employees at your sole proprietorship, you must extend this plan to them as well. Let's look at the example on example 1319. Dave, who's 64, has net income on his Schedule C of $40,000. If he sets up a SEP IRA for himself, what is the maximum contribution he can make? Okay, his first limit is $57,000. His second limit will be $40,000 minus his employer portion of FICA, which you can see the calculation there. It's really taking 1/2 of your already calculated self-employment, which is what you deducted as a deduction for AGI, 1/2 of self-employment tax. But they're just going through the calculation. Remember, $40,000 is not the amount that's subject to self-employment tax. We first multiply the profit by that 92.35%, then by the 15.3, then 50% of that. So 2826 is subtracted from the 40,000. That's the amount that you will multiply 20%. So it's the lesser of that calculation, or 57,000. So he can contribute 7435. His age doesn't matter. So in the next example, it doesn't matter how old he is, as long as he has earned income. What if in the last example, his Schedule C income is $310,000? Now we have to be careful. We have to calculate his self-employment tax. So let's walk through that. 310,000 times 0.9235, 285 is what's subject to both taxes. And I think we are going to ignore any, additional Medicare tax is not a self-employment tax. Okay, so 286, why are they doing that? They shouldn't be doing that. That's an error in the calculation. 286, 285 times 0.029 is his Medicare tax. Okay. Then only 137,700 of his earnings subject to self-employment would be, oh, I see what they're doing, would be taxed at 12.4. I'm just going about it a little bit differently. 6.2 and 6.2, 12.4. Yes. So his total self-employment tax would be $25,377. Half of that would be the amount we have to deduct from 310,000. And I'm getting 297,311. Take 20% of that, $59,462. So it's the lesser of that calculation, or 57,000. So in the end, he can only deduct 57,000 and contribute. His contribution, I should say, is limited to 57,000. Now, he may also be able to deduct that on his tax return as a deduction for AGI. Okay, so keep that in mind as well. There's Dave again. We just did that. I just went through this whole calculation. Here's Another type of plan that's available to self-employed, a 401k individual. Again, these are limited to the lesser of 57,000, 20% of that calculation we just did, plus 19,500. It's an additional 6,500 if you're over 50 years old when you're making that contribution. So assume the same facts, except Dave set up an individual 401k. And he has 40,000 of self-employment income. So now 57,000 or 37,174 times 20%. Okay. Okay. 7435. So it's that calculation compared to 57,000 plus 19,500. The total amount he can make, he can contribute 26,935 so far, or 57,000. And because he's 64, he could add in another 6,500. So his maximum contribution for his 401k, 33,435. Let's see if we want to do anywhere else. Let's see. We did that one. Take a look at the bottom of page 1329, just so you can see this. And we'll talk about the saver's credit and we'll be done. Assume the same facts as above, except Dave earned $10,000 of Schedule C rather than 40. What is his maximum contribution? Well, first we compare, we take a look at 57,000 or the first computation, which would be 10,000 minus 1/2 of self-employment tax on that full 10,000. Times that by 20%. So the limit on the employee's portion of the contribution is 1859 or 57,000. So 1859, then add 19,500. So now he's up to a contribution amount of 21,359. Because he's over 64, okay, he may be able to add up to another 6,500. So add 7 plus 8. Okay. However, his maximum contribution cannot exceed number 2. So although we're adding all these other items in this scenario, his income minus that self-employment tax, 1/2 of that is only 92.94. So that's the maximum contribution he can make. And then it shows that last scenario with a much higher income. Okay, so take a look through that. So that's retirements. The final area is a tax credit that's available for taxpayers contributing to qualified plans. You get this credit in addition to deducting amounts for your contribution. And it's available to lower income taxpayers. Again, it depends on your filing status and AGI. So you can take up to 50% of contribution credit, if your AGI is between these amounts, and then it goes down as your AGI increases. So if you look on page 1331, Tina earned 24,000 this year. She earned 4,000 in salary work and part-time while she was in school and 20,000 from CBA. To get an early start saving for retirement, assume she contributed $4,000 to a traditional IRA. Because Tina did not participate in the employer-sponsored plan during the current year, she may deduct the full 4,000. Okay. And that reduced her AGI to 20. What is the amount of her saver's credit, if any? Well, Tina is single. Okay. Her AGI is 20,000. Okay. 24,000 minus 4,000, so she's in this range. So she can take up to 20% of her IRA contribution. Full-time student, during 4 months of the year. 2,000, so 1 second, I'm missing something here. Oh, you can't use your total contributions. It's the first 2,000 of your contributions. So that's the maximum times 20%. What would be her saver's credit if her AGI is 15,000? Well, now the maximum contribution that could be used to calculate the credit is 2,000. So if you contribute more than 2,000, 2,000 is the limit, else you use the actual contribution. And because her AGI is in this range, 0 to 19, she could take up to a 50% credit. And I believe that is a refundable credit. There's some restrictions there, so you want to take a look at that. Oh, it's non-refundable. I apologize. For some reason, I thought it was refundable. So that's your final tax credit. Wow, pages 1332 and 1333 through 34 show some great information about determining deductibility of traditional IRA contributions and then determining if you could even make a contribution in a Roth IRA. So that's my last slide. That's the end of chapter 13. Please let me know if you have any questions.